Welcome to Economics Diary. If you're new here, this is Olivia. If you're not, hi, welcome back. As I share the income inequality from an article, today's video will be mainly focused on one of the concepts the author introduced, utilitarianism. To see the problems of this framework, author talk about and the suggestion to lower income inequality. Utilitarianism is a philosophy concept referring to a normative ethical theory that aims to maximize happiness and minimize pain for the greatest number of people. So in this term, the government is then introduced as a social planner with the goal of maximizing total utility in society, that they want to move economic resources from those with high productivity and low marginal utility to those with low productivity and higher marginal utility. However, this framework has problems that income differ in part because people will then have different tastes regarding consumption, leisure, and job attributes. Then the variation in preferences weakens the case for redistribution. From the article, author used economics professors as an example, arguing that they could reach higher income occupations such as corporate lawyers, software engineers, and so on, but choose to become a professor to take some of their compensation in the form of personal and intellectual freedom rather than cold cash. Another classic uneasy case for this framework is the interpersonal comparability of utility. The individual's utility refers to the choices that individual makes when facing varying prices and levels of income, but it is not measurable. We can tell the marginal dollar that you consumed creates more utility, in which could also be understood as happiness, comparing to same marginal dollar your sister, your mom, your neighbor, or any other person have spent. The author also talked about the tax system we now have is regressive. Incomes of the rich do not reflect their contributions to the society. In a standard competitive labor market, a person's earnings equals the value of his or her marginal productivity, but there are various reasons that real life might deviate from this classical benchmark. For example, a person's high income results from political rent seeking rather than producing a valuable product. The outcome is likely to be both inefficient and widely viewed as inequitable. To advocate greater taxation of those with higher incomes is that the rich benefit from the physical, legal, and social infrastructure that government provides, and therefore should contribute to supporting it. But it raises the question that how well the government infrastructure benefits. Thus, if the current tax system were regressive, or if the income of the top 1% were much greater than their economic contributions, or if the rich enjoy government services in excess of what they pay in taxes, then the case for increasing the top tax rate would indeed be strong. But there is no compelling reason to believe that any of these premises holds true. From all the argument the author written, we can see to fix differentials in income distribution, we need to consider a lot of factors: utility, taxation, and so on. Almost non-economics could introduce a perfect solution to deal with the income inequality. Okay, that is the end for today's video. Hope you guys will like it, and don't forget to like and subscribe my channel. See you in the next video.